Rafael Serrano knows Miami real estate. There's no doubt about it. More than 15 years ago, Rafael founded Safe Harbor Equity, where he has managed hundreds of transactions involving a variety of performing and non-performing commercial and residential mortgage loans, defaulted debt instruments, and distressed real estate assets. On his company's website, www.safeharborequity.com. Safe Harbor Equity is a private equity firm that strategically acquires, originates, manages, and repositions performing and non-performing asset-backed real estate mortgages up to $20 million. Throughout his professional career, Rafael Serrano has been an active participant in the acquisition, in the development, in the reposition of residentials and commercial real estate properties. And with pleasure, we announce that Rafael Serrano is here with us today, here and now. Aquí Ahora. Aquí Ahora is a podcast, produced and sponsored by PAG.law, experts in venture capital in the Americas. And to host this conversation, we have Aqui Ahora, Juan Pablo Cappello, president and founder of PAG.law. Ladies and gentlemen, we leave with you Juan Pablo Cappello and Rafael Serrano.
Rafael, thanks for joining us.
Thank you for having me, JP. It's a pleasure to be here.
This is great. I'm actually super excited to chat. As somebody who's lived in Miami 20 years, I've seen that expression that history doesn't repeat itself, but it rhymes. And one thing I was very excited to chat with you and what you've been up to the last 15 years at Safe Harbor Equities is that you guys have been focused on commercial and real estate and residential real estate investing. And I know you've lived, the various cycles that we've had in the South Florida real estate market. So why don't we talk a little bit about, if you can, sort of remember how things were in 2008, 2009, and then 2010 as the economic crisis that, started with Lehman Brothers and Bear Stearns, but very quickly sort of engulfed the whole, actually worldwide economy, how it affected the real estate market locally, and, what were sort of the lessons learned in that crisis that may or may not be applicable in, the current scenario and potential sort of crisis in the real estate market that we might be seeing.
Well, certainly 2008, 9, and 10 were very significant. And it was actually really surprising to see the level of chaos that took place. Obviously the collapse of the mortgage market, and then of course its impact on real estate, and of course just the general economy. It was certainly I wasn't expecting it. I think we, as a firm, we were just positioned in the right place at the right time because we had been acquiring distressed mortgages since 2005. That was always our primary core in our business. And then when the market did collapse, we were certainly just in the right place at the right time. But it was it was interesting to see that unfold. I think one of the lessons that, one of the takeaways for us is that.
Well, but hold
you
on.
really
Before
can't.
Let me interrupt before we get to the lessons. So there you are in a very super robust market, and I guess the history of Miami real estate for 100 years, because Miami real estate really starts in the 19 teens, early 1920s, where there's this huge sort of development boom in South Florida because of the arrival of the railroad by Henry Flagler, and sort of the development of Miami. And it's always been about sort of in the boom, a huge amount of arguably over construction and oversupply. And then, these whatever 8, 9, 10, 12-year cycles where then everything sort of collapses. to one level or another. And so you said in 2005, where things still, there was 3 or 4 years sort of that cycle left, and that you guys were buying distressed mortgages, but there was a huge amount of construction going on. So, why don't we talk a little bit about where the market was sort of going into that crisis? Because I think, that's where we can start seeing either parallels to today or differences to today.
Well, absolutely. Listen, that's an excellent point. Well, so in 2005, the market was obviously on a rise. On
a tear.
Really, it was meteoric, to be honest. And I was actually looking around me, and I was surprised to see that, people who really had no real estate experience were becoming quote unquote real estate investors.
Right.
And that was a sign to me. That was a sign to me that something was wrong. I believe it. And it's actually, that's part of the, that was kind of one of the predicates for me beginning to buy bad loans in 2005 was the fact that I remember I was in a car. I was actually taking a taxi ride from the airport, and the taxi driver and I just started to speak, and he mentioned to me, I just did some condo flips and I made over $1 million. And I was like, and my eyes were rolling in my head, and I'm like, what's going on? I'm like, am I living in some, parallel universe? Like this is like Bizarro Land, right? Remember the old Superman comics?
Oh,
What's happening?
Yeah, sorry to interrupt. I had the exact same experience. The difference was the Colombian taxi driver was telling me how he was making a mint flipping, condo development, contracts in Dubai. This was like 2007. And I just remember I had a friend from Spain who had asked me about like doing, investing in a project. And I just called my friend saying, do not invest. When taxi drivers in Miami are passing that tip on to me, we've definitely jumped the shark. Yeah. But so those signs that the market was maybe overheated, what did that make you as a savvy, sort of distressed, value-oriented real estate investor with real experience? What did that make you sort of, do? How did you react to that?
Well, my interest was to be involved in real estate at some level, but in a more profound level, right? In a more protracted, scalable way. But I recognized that with the exacerbation of the market, the way it was headed, there was no way that you could be in it and not potentially suffer from the pitfalls of a decline, right? So at that point, I had always in my mind thought, the purchase of bad loans, of distressed debt, is probably a great way to enter that market and not necessarily have the same level of exposure, but in fact, come into the market in a place where you could still capture some value. Now, they say a rising tide, floats all ships. So I would buy loans. I started buying loans in 2005 for my account and that of some friends and family. And just to be clear, there was not a huge amount. There wasn't that plethora of bad debt that, we typically see during a crisis. But what happened is that there is always a market for bad loans. It's just, it's obviously much more, right? It's just always a more substantial place. Exactly. Right. So that was really like kind of like the impetus for me to begin, that foray into the bad loan world, into the world of distressed debt, understanding that if you value collateral properly and you acquire the debt instrument at substantially below the actual value of the asset, you're probably stand to be fairly well protected in the event that there is a collapse or a crisis. So when the market took a nosedive in August of 2008, I'll never forget, I received a phone call from a very close friend of mine, and I was actually in Europe at the time. And he said to me, you're going to be very, very, very busy. And I said, why? What's going on? He said, Countrywide just filed for bankruptcy. And wow. And I had already been in the business for 3+ years, so it was just fortunate that we were situated in the right place again at the right time, had developed the infrastructure and the skills to be able to navigate that universe. And that was kind of like the impetus for it. So it was an interesting dynamic. Again, hearing the taxi cab driver tell me that he had just made $1 million flipping several contracts. I remember having that conversation with him and thinking, there's no way I can buy into real estate right now. I have to find an alternate way to position ourselves. And that was how the whole acquisition of debt kind of one of the elements that led us to get into that space.
And then as because one of the things that I saw that was very interesting in 2009, 8, and then into 9 and into 10 is it took a while for real estate prices to sort of come down. It was actually like a slow motion train wreck, right? And I had quite a number of friends. In retrospect, they might have ended up doing well in the long term, but they sort of got in too early, right? That the market softened, and they thought they were just getting a great deal buying, sort of 10% below the lows. And I think overall in Miami, the average decline ended up being, I mean, you know better than I, but ended up being between 30 to 40% in most real estate asset classes. So since you weren't actually buying the assets, you were buying the loans on the assets, did it really matter to you in terms of letting the sort of, carnage play out, the market sort of play out and sort of hit bottom? Were you trying in any way to sort of pick a bottom, or it didn't really matter given the kinds of assets you were acquiring?
No, it absolutely matters. And I think that that's a great question. It absolutely does matter. And I think that the strategy, the philosophy that we employed at that time was really one of wait and see. More meaning it was, our thinking was and still continues to be that it's better to allow the market to play itself out over a period of time and reach what we hopefully, can perceive as the bottom. And then to the extent that it starts to go back up, even if you're not able to capture all of the value and you don't time it perfectly, right? Even if you leave, let's say 10% on the table, it's okay to catch it on the way up versus trying to time it on the way down and make a mistake and then lose some of your principal investment. And I'll just back up a moment. I think that one of the tenets of our basic investment philosophy has always been is to preservation of capital, right? It's a preservation of principal. And we kind of have an internal saying, and that is that this is really a stay rich business, not necessarily a get rich. Stay rich investing, not get rich investing, meaning that if you do it properly, and when you buy the loan at the right time, you may not get to the underlying collateral, which is perfectly fine, but you have that underlying collateral as a backstop to the extent that you make the investment at the right time, and there is a substantial amount of equity. So to the question that you asked, one thing I don't like to do is to, say that I can predict the future. I think that's naive. And so we simply attempted, and we did successfully navigate the investment to the extent that we didn't make investments until we felt that the market was starting to correct itself. And listen, it's just an inherent investment philosophy that we kind of go with. So now, listen, and I'll just give you a very high level example. If there was an asset that, let's say, had a loan balance of, let's say, $5 million, and we estimated that the value of the property was $6 million, right? At the time that we looked at it, well, we would typically wait for the market to come back up and let's say go to $7 million. And then that $5 million loan balance, then maybe we pay, $4 for it, right? Meaning that we try to come in at a point where there is a spread between our entry point and the actual value of the collateral, right? Meaning the loan to value.
Right.
So we simply took a much more measured approach, and it's actually, it's what we continue to do today, and it's just really, again, kind of adhering to the discipline of, as I say, not to sound cliche, but really stay rich investing, not get rich investing. It's okay to make a smaller return and protect the investment versus try to shoot for a home run every time.
That's so interesting what you said, that you sort of, because I remember actually one of my friends who turned out to be sort of one of the smartest guys in the room. When Lehman collapsed, he actually, you were, when Countrywide, you were in Europe, and what he did was, when Lehman collapsed, and he was pretty long in real estate at that point, but he had dry powder, he actually went to the south of France for a year. He took a sabbatical, because his point was, if I'm in Miami, I'm going to be tempted to get in. I'm sitting on capital, and people are going to be bringing opportunities to me. And sort of what you're saying, that the risk is, I'm going to allocate my capital sort of too early. And he came back, and I'd never really thought about it. But when I asked him why he came back, he said because he began seeing some, glimmers of hope in the market, i.e. the market was beginning to go up, right? Obviously, you have the risk of the famous dead cat bounce, where a market, sort of reapunta, just comes up a little bit and then, sort of recollapses. But how do you, what kind of market intel, what are sort of your, in tech, we talk a lot about KPIs, key performance indicators. What are sort of the indicators that you look at in the South Florida market? And the reason I'm asking these questions is a lot of our audiences are entrepreneurs and investors from Latin America who have capital, who might have made money in the last cycle of real estate investing in Miami, and may be looking at the sort of weakness of the overall world economy as sort of creating an opportunity for them to invest in real estate in South Florida. So what are sort of the key indicators that you look at in terms of measuring how relatively strong or weak the Florida real estate market is?
Well, so I think that, and that's a fundamental, is the valuation ultimately is one of the fundamental pieces of being able to make these investments. So that's very important.
Right.
So we look at things both at I guess what you would say, a strategic level, right, as well as the tactical level, or rather the macro and the micro. And so some of the things that we look at are the absorption rates, for example, of the location, for example, where the asset may be located, right? So what is the absorption rate into a particular market, a new entrance coming in, right? And what is also the new construction rate of things coming to market, right? And that also factors into the absorption rate. So those are elements that we look at the macro level. And then at the micro level, and mind you, that's just one of many elements, but
right.
Then at the micro level, because we specifically, while we have acquired pools of assets in the past, our primary focus is individual assets one at a time. So what that allows us to do is to actually look at a specific asset and drill down on that asset to understand the metrics that are fundamental in its valuation, right? So for example, the income approach, the sales by comparison approach, right? The cost to rebuild it approach. So we're able to look at it at a much more, it's almost like looking down the barrel of a rifle versus the shotgun approach. And so those are kind of those are some of the elements that we look at, and look, and I'll give you just an example at a higher level. I think that one of the things that a lot of people probably don't seem to take into account is that, so Florida is the third largest state by population in the country, right? Behind California and Texas, with, and prior to the current crisis that we're living, if I recall correctly, I believe that we had a net population gain of somewhere of approximately about 900 people a day moving to South Florida, and New York at that time, I think, was losing about 100 a day, right?
Okay.
So that is an indicator that we are a primary market, right? We are not a tertiary market. And at the macro level, at the more strategic overview, that would indicate that the absorption, right, is going to exist to support new growth, obviously, and things of that nature. So those are some of the things that we look at, right, at the higher level. And of course, at the more micro level, we're looking, as I said, the individual asset, right? Where is this particular asset located? Is it in a high traffic area? Is it a highly desirable asset? Is it in an area that holds its value greater than, say, some other areas, right? So you may have assets, for example, that are out west in Florida that might not hold their value to the same degree as, let's say, something in like Miami Beach, right? So things of those nature.
Right.
Those are some of the key indicators that we look at, when we're evaluating a market and things of that nature. Because while we do focus primarily in South Florida, we do also do things outside, right? So we go to New York, we go to California, we go to Texas. And again, when we're in those places, because they are primary markets that are, with a lot of traffic, a lot of velocity in the sales, right? Meaning a lot of sales volume is taking place. We prefer to be there than, let's say, in the middle of Iowa that A, we don't know, but B, probably doesn't have the same level of traffic as some of the more primary markets. So those are some of the factors that, we look at and identify when making investments.
And in terms of and again, there's, every crisis is different. It's motivated. You're triggered by, sort of different factors, but there's definitely sort of, common elements. And one of the common elements is sort of an oversupply. And at least for a casual observer, and I think, I look at the real estate market, I understand the commercial market far less, and I'd love to get your views both on real estate as well as the commercial market. What I have seen is just the incredible amount of inventory, new construction that's taken place in Edgewater. For the people who don't know Miami, Edgewater is a neighborhood sort of from 20th Street to 36th Street, right on the water, right on Biscayne. Basically, if you're in downtown Miami, the Intercontinental Hotel, which is on Biscayne, and you just go up and you pass the Adrian Arch Art Center, our theater house, then you just start seeing building after building. And these are all buildings that are, sort of 30 plus stories, and most of them have been built in the last 5 years. What's your sense in terms of sort of a supply issue, both on the residential side as well as on the commercial side, as we go into this, sort of macroeconomic situation where you have, at least in the US, 30 million newly unemployed people? So that's sort of my question.
Well, I don't think there's any doubt that the existing oversupply is going to impact, obviously, the pricing of assets, right? Because it just comes down to a supply and demand issue, right? And then, of course, part of what I think drives the demand clearly is people's economic wherewithal to be able to achieve, right? Do you have enough income to afford these rents? And that's and then obviously many of these buildings that you're talking about, they were built in a time when the economy was on an upswing, and then it would not be unreasonable to assume that when those buildings were constructed, projections on income were based on obvious projections on revenue rather,
right?
And the income approach were based on forecasting what people were making at that time and the demand for people to live in those places at certain rents, right? Did I explain that, or did I go off the rails?
It totally made sense.
Right.
And,
so if you build a building and you anticipate that you're going to be able to collect $3,000 a month in rent, right? And you're an investor and you're like, I'm going to buy this unit and I know that I can rent it out for $3,000 a month. One of the ways that you strike a value on a piece of real estate is through the income approach. And that's, you take your income, you multiply it by the 12 months, you have an annual income, you subtract your expenses, what's left over, you divide it back against, right, your investment, and then you have a percentage a cap rate. So, but now if your rents are going down because people can only afford to pay less, that's going to decrease the value of that asset. And that applies for commercial or residential if you look at it from the income approach. So I think that the oversupply of assets, to the extent that it exists for whatever period of time that is. And I think that that's going to fluctuate based on the absorption rate and what's going on. That is going to definitely impact. That's going to impact values. There's no question about it. Just to stay on this topic, but just deviate slightly. I'm friends with a restaurateur who has several restaurants in Miami, and he was commenting to me that he renegotiated the remainder of his 7-year leases at a 50% discount, right? And he had told the landlord.
Gosh.
Yeah, that's very substantial. He said to the landlord at the outset of the crisis, he said, "Listen, I'm willing to give you back the keys to the assets because we understand that this is a new world that we're living in. It's a new paradigm, but you're willing to take the keys back and good luck with it." And the landlord, or he said, "Or I need a 50% discount for the remainder of the 7 years on the lease." And the landlord made that rent concession. Now, taking into account what I just said earlier, if you factor in that, one of the approaches to establish value for real estate is the income approach. Well, if your income just went down by 50%, right, it is not unreasonable to assume that using the income approach, that same metric is going to go down by an analogous amount. So it was quite surprising to me, but not a shock. How about that? Because clearly it's just, and I think that as you talk about that Edgewater corridor, I think that it's not unreasonable to assume that if those buildings, if people can't afford to live there because they can't afford the rents that the owners expected, it's reasonable to assume, I think, that people are going to have to take less rent, and that less rent is probably going to bring the value of those assets down to the extent that that they're viewed or approached as investment properties, right?
Right, and sort of two questions, because some people and I've been actually looking for an apartment, just sort of a pied à terre, for a number of months. And it's very interesting because, there's certainly, and this may just be that, sort of hope springs eternal, but I am interested that there's some people who say, well, the real estate market, yes, there's a fair amount of supply, oversupply perhaps. And yes, local incomes may be trending down. And yes, there will be a lot of small businesses affected. But South Florida is uniquely positioned to have a huge amount of sort of immigration from New York and from other states that are, sort of higher tax, people looking to move to South Florida. And that's going to absorb a lot of this quote unquote oversupply. And then secondly, with interest rates so low, I mean, I was offered, less than 2.5% sort of mortgage if I was interested in buying something. And so, there are some people who are sort of saying, well, yeah, the real estate market may soften a little bit, but don't expect a big correction here, given the increase of people moving to South Florida, as well as sort of lower interest rates propping up values. What's sort of your reaction to that perspective?
Well, I think it's pretty, it's certainly, I think there's just some elements of truth to that without a doubt. And I think it goes back to what we spoke about earlier, how we mentioned that, for example, Florida is a unique market. It's not necessarily representative of the rest of the country, right? Because we have a higher amount of immigration, as you pointed out. And it's interesting, the world population doubles. I think approximately last time I checked was every 40 years, more or less, the world population doubles. But at the immigration rate that South Florida is receiving, it seems to be that our population would be doubling every 20 years. So wow. I think that there is some element of truth to the fact. I think that it would not be unreasonable to say that there's an element of truth to the fact that we are not a representative market of the rest of the country, because we do have a greater amount of people moving in. and that is going to impact the absorption. But I can also tell you what I am seeing at the ground level, right? Because we can talk about things in the theoretical, and then we can just get to the practical. We are seeing residential homes. Okay, so houses.
Right.
I think that's a better way to say single family homes.
Yeah.
Houses are increasing in price in some of the markets in Miami, and for the first time in a very long time, there is actually a limited supply of luxury homes, and that's what we're seeing. And we recently foreclosed on a property in the Morningside area, which, as you know, is approximately in the 60s in Biscayne, right, just next to the bay. And we listed the property for about $1.1 million, and we actually wound up ultimately taking an offer for 1.250, so $150,000 over asking, because we had a bidding war, and it was interesting. It was a bunch of people who had just moved to South Florida. I believe it was New Yorkers and maybe some other folks from the Northeast who wanted this house. And so they just started bidding up above it, and ultimately we wound up taking it under contract at the $1,250,000, which is interesting, right? Because now you're talking about a residential asset that we actually priced it and valued it at $1.1 million as a sale, and we wound up getting it, $150,000 above asking. So that's interesting on the
and your smart money. I mean, your business isn't to leave money on the table, right? I mean, that is very interesting. Because if I list something, our house in Coral Gables, if I list it, the fact I could not sort of know the market and be under, but the fact you guys as sort of experts in the market sort of underpriced it is very, very telling.
Very, very much so. In fact, to us, so the lesson, and it's interesting because that's one of the things that we do in our meetings, in our strategy sessions, and our investment committees, is to always evaluate everything that happens and kind of do like a look back, right? The takeaway. And we recognize from that the ever changing pace, the rapidity and the speed with which things are happening are moving so quickly down here, right? And that is really one of the signs for us that, mind you, we struck our values based on what are called comparative sales analysis, right? A comparative sale analysis is where you look at the surrounding area and you say, okay, this on a per square footage basis is selling for this, and that's what this is selling for. Now, there's no question that our sale price is going to now lead the area in that particular subset because it's a little higher per square foot than anything else. But it really was a sign for us that, maybe it's not wrong to be a little bit more ambitious in our asking, right? That was one of our takeaways. Now, interestingly, conversely, on the condo side, what we're really seeing is that condos are very much at a lull, right? And they're sitting emptier longer. We're observing that they don't have the same level of velocity as home sales. And so listen, we can't say with any degree of certainty why that would be, but we think that may be people's desire to move away from a very densely populated space, given the nature of the crisis that we're living now, the pandemic, people trying to move into homes and things of that nature. So those residential single family homes definitely are on the move, and they are showing they're definitely increasing in value, or they have increased rather. I'm not going to predict the future, but that's well. I mean, listen. At the end of the day, it should not be lost upon people that come Q1 and Q2 of next year, when the government assistance is no longer available to individuals and banks are no longer offering the extensions and the deferments of loans, it's not unlikely that we may see an increase in the foreclosure activity, which is going to obviously mean a lot of assets could hit the market, in which case there's going to be an increase in supply, which could obviously, bring prices down somewhat. Again, I don't know how that plays out specifically in South Florida, but I think just in general, when if you don't have enough buyers and people are not at the same level of income that they were previously, and assets sit a little longer, it could obviously mean that prices of those assets are going to come down.
And so, I guess for the let's talk about a couple scenarios. If you were talking to a friend who's a non-resident, non-U.S. resident, looking, maybe has $2 or $3 million of liquidity, and is sort of interested in real estate as an asset class, just because he or she likes having sort of fierro, hard assets, something that they can touch and feel, something, and ideally an asset or a number of properties. What would be sort of your advice to that kind of potential investor? Do you think buying, the real estate itself, be it apartments or houses, makes sense? What I think is very interesting in your guys' approach is you have the exposure to the real estate, but you're buying loans. How do you think potential non-U.S. investors should sort of think about the opportunities in real estate, even beyond just buying actual real estate?
Well, I think, okay, so if someone wants exposure to real estate, I think that doing it through loans is an excellent place to do it, because you're typically coming in at an entry point where there is substantial value still to be gained, right? So I think that's
right.
Now, granted, I am biased because I am in that space, so I don't know if I'm the best person. I don't know if I'm the best person to ask about that, but listen, all kidding aside, I think that if somebody wanted to come into the real estate space, I would tell them that probably a diversification of the portfolio would be the right play, right? I mean, there's going to be a couple of different scenarios, and this is and JP, just the assumption is that this is as an investment, right? Not as a primary residence, right?
Correct.
Not as a second home.
Absolutely. This is
right.
The famous flight capital that you've seen wash in and out of Miami for the last 100 years.
Sure. Yeah. So I definitely think. Listen, I think that if first I would want to understand what their return profile, their threshold is, right? Where are they happy at what return level would they be at, right? And
right.
And assuming that that whatever the investment meets those parameters, I think that coming into the real estate market through loans offers an excellent place to not only capture additional value beyond your traditional real estate investment, right? So traditional real estate investment would be you invest, let's say, those $2 or $3 million in a small commercial space or some residential assets, and you collect an income stream, right? That is likely going to probably give you, if it's done properly, it's probably going to give you an unlevered single-digit return, right? It's possible that you could do over that, but as someone who is investing that capital and doing it passively, meaning it's not their primary business, right, where they're going to just make maybe one or two investments and put that capital there, find a nice tenant, I could see where they're going to be getting, an unlevered single-digit return. Now by investing in the debt side of it, it's very easy to obtain a double-digit return while still having that underlying real estate as the backstop, as the asset to it, because it's still asset-based investing, right? At the end of the day, whether you own the loan that's secured by the real estate or you own the real estate directly. And so I think that there's greater value to be captured in the note space, because you avail yourself, first of all, of the fact that when you are buying a loan from a bank, you're not dealing with the seller of the real estate who ultimately attaches emotion to their asset. Everybody believes that their asset is worth more than what it's worth. Everybody wants to look at their balance sheet. They want to look at their personal financial statement, and they want to just say, this is what it's worth because I think that this is what I can get. But it's very typical that people don't ever get for their real estate what they believe it's really worth. And as part of what we do is very often when we're evaluating debt instruments is to evaluate the personal financial statements and all of the underlying financial documentation of the borrowers whose loans we're looking at. And you can see where people value their stuff, and then you can see where the exits are, and it's never the same. My only point being that I think that when you buy loans, you really have the ability, you're dealing with a lender who is selling an asset, and they're not approaching it from an emotional perspective. They're really approaching it from a very pragmatic, logical point of view, where they value the asset. They need this number because it's really a function of whatever is on the balance sheet. That's the number they need, and that's the number they can work with. And you, as a buyer of that, are dealing with that on a very unemotional level, as opposed to where if you go to buy, let's say you want to buy a house, the guy is probably going to say, no, this house is worth more. I don't want to sell it. And then ultimately you're dealing with those kinds of emotions back and forth. So this is also part of the reason that, we find debt to be so much more compelling than actually real estate, because everybody can buy real estate and everybody has the ability to buy real estate. Not everybody necessarily has the ability to buy debt because it is a much more nuanced operation, right? It requires skill and it requires the ability to operate a little bit differently, as well as having the real estate experience. So those are kind of the elements that I would certainly encourage people to think about if they wanted to make investments in real estate. Not that real estate is bad. I own a lot of it myself, and through many through many partnerships, and I feel very fortunate to do so. But I know that if we would have tried to buy that real estate from the owner of record, we wouldn't be in it at the basis that we were in, because most of that real estate has been acquired through the acquisition of the debt instrument, right? Which again, the banks are typically, so if you got a $10 million, if a guy thinks this building is worth 10 million,
right,
and he's got a loan on it for 6, and the bank sells it to you, let's say for 6 or something around there, you're getting in at a different place, right? So you have a very different value proposition.
And Rafael, as we wrap up, and I'm super appreciative. I've learned a lot, and this is such an interesting asset class that so many people in Latin America are interested in. I know that we're going to get lots of sort of follow-up questions. If somebody wants to learn a bit more, follow you, do you have any presence, blog, anything on social media where people can sort of follow you? What would be the best way for people to learn a little bit more about what you're doing?
I have to confess, I am not a social media. I'm not a very big participant in social media, and I am embarrassed because I only recently just I just only recently started getting on Instagram, and I don't even know if that really counts as having anybody follow me. But well, I think that if somebody wanted, yeah.
Well, I know on LinkedIn. I mean, don't give any personal information. I know you have a presence on LinkedIn because I'm looking at your link, Rafael Serrano, at Safe Harbor Equity, and people can message you through LinkedIn if nothing else.
There you go. You see, you're more in tune with that than I am, and you're absolutely correct.
Hilarious.
But you're a tech guy, right? You're a tech guy, and I aspire to be as savvy even at the most marginal level where you get. So excellent way if people wanted to contact me, and certainly I'm happy to speak with anybody, and to the extent that we're able to provide any feedback. And of course, there's our website, which certainly our company website, which certainly describes a little bit of what we do. And I think on our website, there may be a couple of, I think on our website, if I'm not mistaken, I spoke at a conference, and I think they did an audio recording and posted on the website as well. A little bit, it gets a little bit more into the granular details of buying debt. Right, versus us, what we're doing here is talking more at the strategic level, right? It really gets down into more in the details of what what that operation may look like. So if anybody wanted to have more feedback, they're certainly welcome to go there, or of course, reach out to me through LinkedIn.
That's awesome. SafeHarborEquity.com. I'll include all that in the show notes. Rafael, the best is yet to come. I don't know if for Miami real estate, but for smart investors like you, there's as the expression says, you never let a crisis go to waste. So we may have a lot of opportunity.
I couldn't agree with you more. I really do. I do believe that there is a lot on the horizon. And listen, it's a bittersweet situation, obviously, but the reality of it is it is here, and we are living it. And what we're doing is we're navigating it now. And yes, I think that there is going to be a tremendous amount of opportunity.
Wonderful, buddy. Big hug, and we'll be in touch. Really appreciate you making the time.
Not at all. Thank you, JP. Very, very appreciative of your time as well. Have a great one, okay? Thank you so much.
You too. Cheers. Bye-bye. Thanks so much.
Este fue otro programa de Aquí y Ahora, auspiciado por PAG.law, especialista en Venture Capital. Hasta pronto.